When we factor in just the capital value of this fund, it underperforms the underlying index. However, when you look at capital value plus distributions, the results actually reflect. What's up, you guys? Welcome back to the Average Joe Investor channel. In today's video, we're talking about two high yield income ETFs, which we talked about all the way back in March of 2024, right when they launched. That is SPYT and QQQT, both from Defiance ETFs. Now that they both have some months under their belt, we're going to take a look, understand exactly what these funds do. We'll look at their underlying results and figure out, do these have any type of place in our portfolio? Okay, so SPYT, which is the Defiance S&P 500 Income Target ETF. And then we have QQQT, the Defiance Nasdaq 100 Income Target ETF. Now, SPYT launched way back in March of 2024, right here. However, QQQT didn't launch until 6/20/2024, so we don't have quite as much data with this one. We'll look at both, just for the record, but we're going to get a little bit more awareness of and understanding of SPYT because we have a little bit more time to look at the distributions and the effect on the underlying capital value. The reality is, whenever we talk about income ETFs, the high yield income ETFs that we talk about on this channel, we always need to be cognizant of how these distributions affect the underlying capital value or potential for NAV or net asset value erosion. So what makes SPYT and QQQT different than other types of income ETFs? Well, from what I can tell, these are the only ETFs that utilize credit spreads in conjunction with owning the underlying index. Now, a lot of times when we look at income ETFs, the high yield ones, a lot of them will hold an index or something similar to that, and then they will sell covered calls or cash secured puts to generate income. These are a little bit different because it's more of a hybrid between capital value and income. The reason why is instead of selling just covered calls, they utilize what are called credit spreads. As they indicate on the website, the goal is to achieve a target annual income of 20% in the S&P 500 using options paid out monthly. Their income is generated from the options. It says here their option strategy involves selling a call option while simultaneously buying another call option at a higher strike price. By focusing on short-term options, we aim to offer an enhanced yield compared to traditional option-based strategies. What they mean here is instead of focusing on monthly, which is what you commonly see with these types of high-yield income ETFs, or maybe even weekly, we're looking at daily or shorter-term income strategies, which will increase the yield. I'm going to break down for you just in a second with a graphic exactly what I mean by these credit spreads, but essentially they're selling a call option and they're buying another call option at a higher price. The income generation, as they state right here, is designed to generate income through option premiums derived from selling index call spreads, the primary driver of the fund's yield. We sell at the money or near the money call spreads to retain upside growth potential and aim for a target annual income level of 20%. So here's what I mean by this. So we've got a graph here. The green line right here reflects the current market price at this point in time right here. Then we've got a sold call option. This is the one that they sell to create income. Okay, this blue line obviously is closer to the green line than the red line is to the green line. This one is their purchased call option, okay? So this one is sold, and if it was just selling one call option, this would be capping their growth potential, okay? Creating income, but capping growth. By also purchasing a call option, they're allowing themselves to grow or collect growth in the capital value of the underlying stock if the price rises from here to above the red line. This spot right in here between the red and the blue, this is the opportunity cost. They will not earn any capital value here. So the reason why they do it this way is the blue sold call option, because it's closer to the market price, is going to be worth more than the purchased call option, which is in the red right here because it's further away. This means that even though they're selling a call option and purchasing one, there still is a net credit or still net income coming into the fund. So they're creating income, but they're also allowing for some growth if the stock market goes up significantly during a specific time frame. Here's an example of their holdings. So you can see that the underlying stock they're holding is IVV, the S&P 500 ETF. Okay, they're not holding individual stocks, they're owning the ETF that holds the S&P 500 essentially. Then you've got some cash. Then you've got the two options here. This one here, 5510, is the one that they sold. You can see that here because there's a negative 80. So they're short this position, they sold it. And then they also purchased 5520, which is further away. It's going to cost less money. You can see the spread here, 28.90 versus 23.05. So there's still a net credit coming in. they're creating income, and they're also allowing for additional growth in the underlying stock price if the market significantly increases during that time frame. Here's a look at their distributions so far since they launched, starting here in March of 2024, 34 cents per share, 32, 33, 33, 33, 33. So very consistent distributions. We're going to have to see just what that underlying capital value has done during that same time frame. You can see the distribution rate is right around 20%, which is right where they want to be. Before we dive into the actual spreadsheet I created to emphasize or to really dive into the results, let's take a look at QQQT. It's essentially the same, just with a different underlying index, the Nasdaq 100 instead of the S&P 500. Same or very similar distribution rate, 20.86%. Target income of 20% with the Nasdaq 100 using options. I'm going to scroll down here. All this is the same, except for the fact that it's a different underlying index. Scrolling down here, you can see, again, they launched on June 20th. Here's a look here at the actual holdings. Again, QQQ, which is the Nasdaq 100, the underlying stock. Then they're selling options on NDX, which is the Nasdaq 100 index. This is the one that they sold right here at 18,950. And then here, 18,980 is the one that they purchased to make sure that they have some opportunity for growth in the underlying stock. All right, we're going to dive into the spreadsheet here that I created for SPYT and QQQT. Very similar structure to what I've done in the past. We've got SPYT data, SPY, which is the S&P 500, to compare the results, QQQT data, and then QQQ. We've got the dividend income breakdown and the graphs. So you'll notice here that in all these scenarios, we're looking at $100,000 as a lump sum investment at the beginning of the period. No monthly contributions, no reinvested dividends. We're just going to see here what happens when you look at the capital value during that time frame from the beginning to the end, and then also what the total returns look like when you factor the capital value as well as all of the distributions made during the time period. So SPYT, we spent $100,000 or invested $100,000 here on March 7th, 2024. We scroll all the way down to the end here through 9/4, and the total value of the capital started at $100,000, now worth $96,339 and 88 cents. But how does that compare to the S&P 500 during that same time frame? S&P 500, scroll all the way down, 107,020 and 7 cents. So there's a pretty significant difference here. It went from 100 down to 96 versus the S&P 500, which went from 100 up to 107. Now, this is just the capital value, so we want to make sure and also look at the capital value plus distributions or total returns. For SPYT, going back over here, if you include all the distributions, which in total were $9,943.15, again, assuming we invested $100,000 at the beginning of the period, the total return here is $106,283 and 3 cents. Same thing for the S&P 500. The distributions during this time frame were $651.50. So that plus 107,020 equals a total of 107,671. So the S&P 500 did outperform SPYT, but not by a lot. Here's a look at that capital value only. The orange line is the S&P 500. The blue line is SPYT in this situation. They were very similar. The S&P 500 outperformed during this time frame. We can see that there were some caps, obviously, in the growth, and because of the fact that they were selling an option and buying an option. But at the end of the day, when you factor in both capital value and distributions, let's look at the below graph right here, you see a much closer race with the orange and the blue lines. Essentially, they're about the same during this entire time frame. Now, let's look at QQQT and QQQ. Now remember, we have less data here, only from June 21st, only 2 distributions during this time frame. So just keep that aware. We want to see a little bit more time pass before we really understand what's going to happen with this fund with respect to its stability. But we'll look at QQQT here, started with $100,000, scroll all the way down to the end of the period. That 100 turned down into $91,865. With QQQ, or the Nasdaq 100 index, we started at 100, and it's now worth $95,924 and 44 cents. So very similar. Both funds were down during this time frame. If we look at the capital value plus distributions, in other words, total returns for QQQT, we had $91,865 plus distributions of $3,189.57, or just 2 distributions, which means total return is $95,055.17. With QQQ, we see that the capital value was $95,924 plus $158.69 in distributions for a total of $96,083 and 13 cents. So you look at the differences there, not much. So those are actually very closely tied together during that short time frame. Let's look at the graph here. We've got QQQT versus the Nasdaq 100. So in pink is the Nasdaq 100 versus yellow QQQT. The capital value only very similar here, but the Nasdaq 100 does outperform. When we look at capital value plus our distributions, which is right here, we see that very, very close together. At times, almost exactly the same, especially right here around August of 2024, very recent. However, since then, the Nasdaq 100 has outperformed QQQT on a total return basis. But again, we have to remind ourselves, we don't necessarily buy these income funds potentially to match the S&P 500 or match the Nasdaq 100 because oftentimes that's not possible. You always have to choose or have a balance between income and capital appreciation. When we talk about the S&P 500, the Nasdaq 100, these are capital appreciation funds, right? You're buying the market, hoping for growth in the fund over time. These income funds here, the fact that they're pretty much keeping up with the underlying indexes is really cool to see when you factor in distributions and capital value. Let's take a look at the actual income because that's why we would ever own these funds, because of the income. Let's look at the dividend income tab here. This is right here in orange is SPYT's income. We have 6 distributions, 4, 5, 6, 7, 8, 9 here. Very stable on the dividend per share. And assuming we had $100,000 invested, your monthly distributions are about $16 to $1,700. With QQQT, we only have 2 distributions that are exactly the same, 32 cents per share, which would be about $1,590 or $1,600. And just as a quick idea here for an income scenario, if you assume, based on the actual results here from the past 6 months, if you'd invest that $100,000, the annualized income for SPYT would be about $19,886.31 based on the historical 6 distributions that were actually received. If you'd invested $250,000, the annualized income would be approximately $49,715. And if you'd invested $500,000, which I know is an extraordinary amount of money, especially in a one income fund, your annualized income would be $99,431.53. So very interesting there. I've got a graph for the income as well. We'll scroll down here. You can see that the distributions here are there's a little bit of volatility here, not by much though when you factor in just the size of the index. So you see some bouncing around between around 1680 to 1620, up to 1680, back down to 1640, and then 1660. And obviously with QQQT, the income was the same for both months, right at $15.94.78. So my big takeaways with this fund are, if you're looking for a little bit less income and a little bit more stability, it does appear that these funds appear to be on the right track with that, a little bit more balanced, keeping up somewhat more with the indexes, and still delivering pretty solid income when you factor in what most dividend stocks and dividend ETFs are generating about, 3, 4, 5, 6% maybe. We're talking about 20% annualized distributions here, which is pretty amazing. Time will tell if this funds actually can stay consistent with their income and their growth moving forward. If you like the idea of income and you are not in favor of selling your own options, this might be a fund to keep an eye on moving forward. If you want access to this spreadsheet and all of my other spreadsheets, make sure to check out the Average Joe Investor Patreon community and the Discord chat. Tons of value there. A lot of DIY investors creating income in their own portfolios with funds like this, as well as selling their own options. Also, you can get access to me one-on-one to talk through your own scenarios, develop income strategies, and level up your income generating with your portfolio. If you want to learn more, check out the link down in the description below. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many of these comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.